Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. Our guest today is Ginger Rothrock. Ginger is a senior director at HG Ventures, the corporate venture investing arm of the Heritage Group. The Heritage Group is a family-owned business managing over 30 companies specializing in heavy construction and materials, environmental services, and specialty chemicals. Before joining HG Ventures, Ginger served as the Vice President of Technology and Commercialization of RTI International, where she oversaw the commercialization of a $1 billion portfolio of research and development. Ginger also successfully founded 2 companies and is an accomplished scientist. Ginger holds a PhD in chemistry from the University of North Carolina at Chapel Hill and previously worked as a research associate for the U.S. Environmental Protection Agency. Ginger, welcome to the show.
Thanks, glad to be here.
For those who might not know the Heritage Group, it's a 4th-generation family-owned business with managing 30 companies. It seems pretty big, but could you tell us a bit about the Heritage Group and then maybe what you are doing at their corporate venture capital arm?
Sure. And I had not heard of the Heritage Group when I got a text from my boss, the head of the Ventures Group. So not surprising if folks haven't heard of it. But we are a 90-year-old private Midwest U.S. company. We're the largest private company in Indiana and probably one of the largest in the Midwest. We've got almost 40 operating companies in the 3 industrial segments that you mentioned: heavy construction materials, which is primarily the fully vertically integrated supply chain for road infrastructure, quarries, asphalt materials, paving. Also environmental services. So Heritage Environmental is the largest private environmental services company in the U.S., managing industrial waste reduction programs for thousands of customers. And then a chemicals business that includes things like fuel, commodities, and specialty chemicals. So I know your audience is mostly financial. And so through the decades, the Heritage Group has grown through mostly, I'd say, incremental acquisitions in our core markets and focused on maintaining some of those core family values, building long-term, enduring relationships, investing in people, not a lot of fear of betting on the unknown. We've got the private company here. And so HG Ventures was started probably intellectually 5 years ago, but physically 4 years ago, basically the product of know what you don't know. So we have this future view of our legacy industries. There's going to be massive change, right? Digitization, everyone talking about software eating the world, decarbonization, rise of climate change. So how does the Heritage Group get more nimble in this fairly conservative old world? So we have a thesis partnering with entrepreneurs building the future of sustainable materials, infrastructure, industrial processes. But very simply, we invest where the Heritage Group can help. And so we try to leverage people, assets, relationships in our operating companies support entrepreneurs who are scaling their businesses. So we look at our core industries, those adjacent, and even work on disrupting ourselves. We're actually set up in a hybrid model where we work to take the best of corporate VC and traditional VC and eliminate the challenges. It's, again, all about leveraging our assets to help the entrepreneurs succeed, not by investing in a bunch of companies, which may be relevant for like one business unit. We're looking for those driving change in our industries. So like most CVCs, we invest off the balance sheet. It's about 50 to 75 million allocation per year to our investments. So it would equate to about a $400 million-ish fund. Process and metrics for success are a lot like a traditional VC. So initial check size ranges from 1 to 15 million as a lead or syndicate partner. We've got capital for follow-ons. We've probably led half to 2/3 of the 27 deals we've done in the last 4 years. So I'd say we're pretty active. We can invest anywhere in the world. A number of our deals in capital have gone to Midwest because it's kind of an industrial center outside of Silicon Valley. And I think we've done about 250 million to date. In addition to our fund, we actually established and fund an accelerator here focused on those same hard tech industries that sits right outside my door. So we've had 29, I believe, pre-seed and seed stage companies go through our accelerator, and we're about to welcome 8 more.
Wow. I took already quite a bit of notes for things that we could dive into. Let's maybe start with one question that immediately came up. I read a bit about the areas the businesses are in that the Heritage Group is managing. You said this is where you're focusing. And the intro, maybe interesting for listeners who want to know about more sustainable investing, came from Laurie Minute, which I had on the show some episodes back. And her background is deep tech, environmental ESG investing. When I read the industries you're in, there's not really impact investing, environmental investing, like top of mind coming out. How does this go together for you?
No, it's a great question. And while we don't necessarily have an impact target or a carbon target like many do, we do take that into account in other ways, mostly because we believe that there's so many climate solutions beyond carbon. So I'm talking, things like sustainable waste management and the circular economy, reducing energy, fresh water consumption. Water is very much the next carbon, in my opinion, right? You have greenhouse gases beyond carbon dioxide and methane. You have generally synthetic molecules, not to get too techy, but there's lots of new compounds, plastic, metals, radioactivity discharged by humans. These can have detrimental consequences on health. And so many, in my opinion, of the targets that are set today just aren't broad enough to encompass everything needed to think about the climate and the environment. So we don't put ourselves out there as a very specific impact or whatnot, but we do, I would say, virtually every one of our investments has call it a sustainability metric of some kind.
I would really love to later dive into this sustainability metric, but let's not get ahead of ourselves. What I'm a bit more interested for now is how did you end up doing what you do? I read in your bio, you were the Vice President of Technology and Commercialization. What did that entail? You founded 2 startups. So maybe let's start with the Vice President role. What did you do there? Like, what kind of role is that?
Sure. So I had a startup. I was a founder, won a ton of hats. We were in the nanotech space in the early 2000s, and I ended up being very drawn to the material science, environmental side of things. So we actually spun off a separate company to look at batteries, construction materials, photovoltaics, which ended up not working out because of the clean tech crash of 2009. I actually had a term sheet pulled from me from a large investor. And so just so you know, just give you a little lead into there. And then personally, I wanted to have a family. My husband wanted to start a company. So I ended up going to a very large not-for-profit research institute because I see there's a lot of government funding. There's a lot of interesting things happening at the time with carbon capture. This was a while ago. This was like early 2010s, building materials, med devices, but it was all none of it was focused on the commercial markets. And so I actually went to that organization intending to find my next startup over time. So I built a commercial sort of engineering department, and my executive team there basically granted me an internal seed fund to sort through all of our assets, pick the ones with commercial value, fund them to the point where they could be licensed or spun off into a separate entity. So yeah, I had a number of scientists and engineers reporting to me, but I got to do the things that I really loved, which was connecting with scientific innovators and showing them how the impact of their R&D work could be expanded into a startup or licensed to a commercial group. And I ended up getting promoted to overseeing all the engineering functions and talking with a lot of folks in the community. And that's how I ended up meeting a man named Kip Fry, who was a very well-known local entrepreneur and investor. He sent me a text. He said, "I'm doing something really interesting in Indiana. I think you'd make a great VC. Come see me." This place called the Heritage Group. That's how I got into VC, and I went, and they were building this really, really interesting thing. And so I was actually not looking to be a VC. It was something that just kind of fell into, right?
Interesting. I mean, it kind of sounds like before that you've been a VC at the same time as an entrepreneur, kind of wearing both hats at the same time. You said something interesting there. Like you got a term sheet pulled, you've been through the clean tech 1.0 bubble. Can you tell us a story of like how that happened, what impact that had on you, and a bit more on that story?
Sure. I mean, I certainly won't disclose any firms because that's tough. We were out pitching. It was a really exciting time. I was out in Silicon Valley and had a great experience with a group, and they had given us a term sheet. I think it was going to be an early stage company. I was thinking $4 million on a $7 million pre-money. So again, back in 2012, that was a pretty big thing. We had spun off of my previous startup. And I never understood exactly what happened, to be completely honest with you. We had a term sheet, we had it signed, I believe, and we were going into some diligence there. And we basically got a cold call one day that said, hey, we're not in anymore. And so we had this whole board meeting and discussion of what we were going to do. And it happened so quickly with absolutely zero explanation. And of course, it destroyed me, right? It was something that I've been working on for about 3 years inside of our other company. And the drug delivery side of the company is going really well. It's Liquidity Technologies. They went public in 2018, but it wasn't like they said, oh, it's no big deal. You can come back and do the, drug delivery side. We're working with this large pharmaceutical company. You can lead that project. And I was like, no. I was so fixated on the value proposition of changing construction, changing renewable energy, and all of that I was honestly paralyzed for probably 6 months, going through the motions, figuring out, do we keep it as a part of Liquidity and not? And about 3 months in, I was like, I have to leave. And it's a very personal, tough decision to leave a company that you helped found. But I needed to find something else. And I knew I wanted to stay in the startup world in some way. And at that time, I had a 2-year-old. And I knew I wanted to have another kid someday. And so all of that came into play. My husband was a teacher. And so it wasn't like we had, a whole lot of income to rely on. And so I had to find my next thing that really matched my passions. And so I ended up just saying, hey, you know what? I believe that changing the world and the environmental side is still my path. And I'm going to make a jump to something else.
Wow. Thank you for sharing that.
Yeah.
That is, when we started chatting a bit before, you mentioned like this or that. This is an intense story. What lessons to turning this around into a positive thing did you learn? And if you did, what were the lessons you took away from that horrible experience? And again, trying to spin this somehow positively, does this help you with the investments you do today?
Oh, of course. People always say, why is being a scientist or engineer having this experience maybe better? And I said it was never on my radar, but it's a different scale of impact, right? Having every company in our portfolio is science or engineering based, right? We've got technical CEOs. We've got 95 companies that pitch to us are technical. Scientists can make great CEOs and natural entrepreneurs. And in many ways, scientists are naturally resilient, right? Scientists are willing to start new things. They don't freak out about failure. It happens in the labs every day. And through that experience, I've both as being a scientist and being a founder and having, bad things happen to me and, boards that people were behaving poorly. There's all sorts of things, right? Having a more natural comfort with failure and more of an experimental mindset has helped me both be more empathetic to my founders and also see what I don't want to be. Right? There's all the tenacity, grit, goals, passion, perseverance. Everything is still quite personal to me, as it is to many of our founders, right? And so many of our founders, they say, I must succeed and find a way. It's part of who I am. But when bad things happen, how do you split apart your work from your person? Learning at the School of Hard Knocks, it's easier to sit with someone and be vulnerable and say, look, I wasn't allowed to be CEO of my own company. I had that experience. I've had to turn people. We've pivoted the company in a way that I have not dealt with before. And just using my own challenges and, personal failures and feelings to help others feel like they can be in a space to share things that are really hard, because being a founder is just incredibly difficult, as you learn as well yourself personally.
Yeah, just starting to learn all those things a bit, but I think it's a super good thing that as an investor, you know what people are going through, especially in the combination with being a scientist. I imagine a scientific approach is basically you're setting up an experiment and then you try to prove yourself wrong and okay, I didn't prove myself wrong. So the experiment was a success, but I didn't prove myself right. You never can prove yourself right. You can only prove yourself wrong. And basically by way of eliminating wrongs, you try to get, okay, this must be the way, right? Now thinking about it for the first time, this is a very entrepreneurial approach, right? As an entrepreneur, you try to, okay, if I do this or do this, okay, this doesn't work. Left, okay, right, left. You try to always go, you hit a wall, you turn around, you walk into the other direction.
Every field of entrepreneurship is about, having a hypothesis and testing it with your customers, right?
Yeah. What happened when you were not allowed to be CEO of your own company?
It was a different time. I'm 45, right? And when I was 25 and female, it was not popular for women to be in that role. It was also not popular for scientists, to have technical founders, right? Everyone said, you need an MBA, right? You need an old guy, what have you. And so in many ways, one of the things I also learned is how do you pick your battles? And I was not good at that early in my career. I'd say anybody thinking about their career right now listening to this podcast would be like, pick your battles carefully because you can ruin relationships, right? I wanted a seat at the table. I wanted to, many of us have had success in their universities or in their graduate programs. And then you get to the real world and it's like, oh, maybe some of that doesn't apply. But you come out with guns blazing and thinking you're, hot stuff. And you actually have a lot to learn. If there's anything being an entrepreneur and investor has learned is humility, right? And so that was one of the times where I said, you know what? It took some thinking, but I was better off in the long run. And I'm glad I didn't fight back on that one because I learned a lot about leadership and building a company, not being in that seat. And that's also one of the ways we look at, the companies that we're invested in. What do we look for in entrepreneurs, right? That just leads right in there. It's always team, market, tech in that order for a reason, right?
That would be actually been kind of my segue into what are you looking at the company, especially since you had this experience, right? Are you particularly on the side of tech founders, female founders, trying to push that more, or do you have ways to avoid that bias? Because you obviously probably would have made a good CEO because you were passionate for that. You were the scientist. You had this experience. And I think the picture of the old white male that has to run the company is also shifting enormously over the last couple of years. Do you actively look for things on how to get an objective check mark on who would be the best CEO, the best board members or something like that? Do you have any tools in place to, lead into your own biases that we all have, even if we mean it or don't?
Yeah, lots of questions in there. So maybe let me circle back to the underrepresented founder thing, because generally, even though we're investing in this hard tech, scientific, whatever, it's very much the same things that we look for in entrepreneurs that other VCs do, right? Team, market, tech. So in the team, I believe there are just a few crucial things that the entrepreneurs need to have. And a big one is self-awareness, right? A self-aware CEO knows their strengths and weaknesses. Can they hire and surround themselves with people that know different things where they may have gaps? Can they learn things that are critical to the business? Is their network broad, right? We look for technical folks that have a network beyond the scientific world, for example. They are tenacious, right? You need to find a way. Teams that are relentlessly pursuing success, but that has to be balanced with not being married to a specific technology solution. You want to see, like we talked about before, constantly seeking to validate the problem from the market side. We see many founders in our industry are relentless, but relentlessly certain their specific solution will be the best and not listen to customer feedback. And the gift of storytelling is so crucial, right? Can they tell a big picture story, critical for attracting great talent, bringing on customers, attracting investors? And going back to that team, right? It doesn't necessarily have to be the scientist or the founder, right? That's the CEO. You actually need, especially in our industries, you need the experienced person that knows not to pull up to the construction site and quarry in their fancy Tesla, right? And the young person that's pushing the envelope, right? A lot of folks that have been in the legacy industries also have a really hard time pushing the envelope, thinking differently. You have to talk the talk in the industrial world, but you also have to be willing to overturn it. And so I think having a mix of people is critically important in the team. And that's one of the things that we look for. On the underrepresented side on the team, that's incredibly important to me based on my personal experience. We make sure we've got folks on our ventures team also that has even different experience than us. We hired an immigrant woman recently who's brought just a really good different perspective to our team. We're looking on constantly diversifying as well. It's tough, especially in the industry we invest in, to find and encourage women to start companies and join. And when I find them, I actually will often spend more time with a female founder if it's clear that she is not quite ready to pitch, right? And so I will often do a practice meeting with her or any underrepresented founder because it's, there's data out there that says underrepresented founders don't often have access to the same folks to help them prepare the same network. And so very open to cold intros, very open to helping someone, just tell them what we're looking for and give them extra coaching. But at the end of the day, I'm willing to give, somewhat, we'll call it unfair access, but there must be a totally fair outcome. Every single founder goes through the same process in our venture fund. We have an intro call. Could it be a fit for us? We're very, very sector specific organization as a CVC. That's pretty common. So we kind of screen for, can we help you, right? Can the heritage group help you? And then we do a pitch with the full venture team and we try to debrief right away. And then we go into diligence, and happy to talk a little bit more about what we look for. But that's, going back to the team side, that's really important. And then on the diligence side, and, we're looking at the market and the technology as well, right? We want to see scale and visibility to achieving a long-term financial forecast. Sometimes at heart, many of the companies we invest in are pre-revenue, even later stage, right? Because they're trying to build a very difficult product. It takes a lot of capital to get to something, but we could see supply arrangements, offtake agreements, partnering, sampling hints that what they are doing is a solution that somebody is willing to adopt. Customer references are incredibly important in the things that we do as well. And we want to see if the founder has a reasonable time to market and adoption cycles, because pilot risk, adoption risk is significant in especially the B2B industries that we operate in. And then the technology is something that we're all very strong on. That's one of the benefits of corporate venture capital. I can call on any one of a number of experts, but we know what scale people are at. We dig in quite deep to unit economics on the technology side as well.
Lots of things to dig into. One just curious thought I had is, do you give, based on your experience, founders that might, not be so great at storytelling? Because maybe the stereotype applies a bit, like spending all day in the lab, not pitching so well. Do you kind of try to give a bit more leeway? Or on the other side, founders that pitch very well, maybe a bit too well, just has this slight skepsis. It's is him or her really that great of a scientist if apparently all they do is pitch all day long? That would be really interesting to hear.
Sure. I think we do give a little bit of leeway for pitching, but not too much, because storytelling is not just important for raising money. It's also important for customers. It's also important for recruiting amazing people to your team. So we actually put a fair amount of weight on storytelling. And some of that may be one of my partners, Kip Fry, also went to film school. So storytelling is always an incredibly important thing with our group for those who actually dig in and learn a little bit about the backgrounds of the various people on our team. So I would say possibly if we really know the technology is something that could fundamentally change the industry, but at the same time, I don't think we give too much leeway there.
You said you were looking at reasonable time to markets. You really dig into unit costs. I mean, I get that you have a strong scientific background with a lot of experience in that. But then the Heritage Group has nearly 40 companies. They not do all exactly the same. How do you know with the different companies you invest in? You said you invest in Europe, you invest in the US. Do you get help from the people in the group to say hey, would that be reasonable? What are you considered reasonable? How you approach trying to find a reasonable outcome?
Sure. And some of that goes back to how do we use our colleagues at the Heritage Group and how do we add value to our investments, both, in the diligence process and within our portfolio, right? And I think CVCs, you have to be very, very careful about not crossing a line and engaging folks in your operating companies with those in the entrepreneurial community, because there's been history of folks that have taken knowledge and used it in the wrong manner. So I think we're very careful about how we expose folks in our operating company to companies, either in our portfolio or doing diligence. That said, we love for any founder to not only pitch us, but also we like to do a technical pitch or a customer pitch. And we listen in on that and say, hey, founder, would you be willing to talk to one of our operating companies? And they can bring in a totally different deck. We don't want any financials in there or what have you, and say, hey, I'm doing this plastic recycling business. Here's the technology that we've looked at. Here's, where we are in our process. Here's what we're thinking about doing going up. And then they can ask very deep questions that I never would know, right? Just because I'm a PhD doesn't mean I know anything or hardly anything anymore, right? But we've got folks that are often doing the work or seeing the problems that these entrepreneurs are trying to solve every day. And so we use it as a tool to both see if there's value in the investment that we might make on the diligence side, but also give these entrepreneurs just full access to a customer. There's so much first pilot and sales cycle risks in the areas in which we invest in, right? Many of these companies ultimately sell their products to industrial corporations, and these corporations don't always move at startup speed. So let's just remove that friction and give them direct access to 10 to 20 experts in this field to just go back and forth and ask questions. And we do a survey afterwards. We have them write written responses. What was great? What was challenging? Where do you have extra questions? And we remove any confidential information for the Heritage Group, but we give 100% of that feedback to the entrepreneurs in written form. And so hopefully we're providing some value add as well during our diligence process. And then that just compounds, right? As we say, we only invest in things where we can help. And then, now we get people really excited about the companies we're invested in. And then we can have them help on everything from what is the price of a chemical right now, in this part of the world to, hey, do you need help with this assay or what have you? So happy to go into like some of the ways we add value to investments. But for us, we try to make it a two-way win-win and exposing our folks to really interesting and things that could happen and that are the future of the technical areas we work in, but also the entrepreneurs, giving them access to not just, some M&A or venture person, somebody that's actually, touching products and customers.
I feel like this is getting more and more important for VCs, that there's now more and more money out there. Maybe not and we can talk about that in a bit. Maybe currently, as of July 2022, not so much more money anymore, but there has been a strong upward trend in private investments over the recent years. And I feel like adding value is coming more and more. I want to shift gears slightly and I'll leave it open to you if you want to talk about, if you want to tie it in with like adding value. But you mentioned a bit important investment topics for you and HG Ventures, that being circular economy, sustainability of water, and water being the next carbon. Could you talk a bit more about why those areas are of focus or of interest to you and how you approach those topics?
Sure. And we can wrap back to how we add value. Let's just go to the trend space because I think that's a little bit more interesting. And maybe I'll start macro level, right? What are these trends we're seeing in, we'll call it industrial tech or hard tech in response? Climate, sustainability, what have you. First with economics, right? It's becoming more and more expensive to haul and treat waste. And you mentioned water, so I'll say that. Out of the back of a facility often comes a hazardous waste that's mostly water. Can you imagine right now what they're doing in the last 100 years? They're putting it on a truck and hauling it to a central location to be treated. That is very expensive from both a carbon and just a dollars perspective. And at some point, the cost of water and carbon will factor in there, right? Also on the economic side, there's labor shortages. If you can automate, that's low-hanging fruit. That's becoming interesting. Supply chain decentralization. I'm sure all of your listeners have heard about the challenges with supply chain. Can you reuse anything in a facility, right? And we'll come back to the specific circular economy, but there's a great economic argument for reuse or concentration of raw materials, such as maybe a metal that may be in a low level present in the waste. Can you reuse that in the facility? There's great savings. And then there's, being in Europe, there's increasing landfill taxes, there's waste import bans with China, right? That's all the economic side that we see and have brought into our thinking when we're thinking about where are we going to be investing. You also have mentioned, ESG and public perception. There's still a decarbonization macro trend. There's sustainability mandates within the supply chains happening. Companies like Intel are requiring that their suppliers report on and improve manufacturing and waste practices. People are seeking visibility and action across the supply chain. And public awareness of waste and water quality issues, right, is driving the market towards increased transparency. The Flint, Michigan crisis is not just a Flint, Michigan crisis. People are interested in what's in their water, and consumers more than ever are interested in knowing what's happening there. And so if you take some of those things, and then, can't forget changing regulations, right? Europe has some really interesting extended producer responsibility. So if you make it, you're responsible for it later in life. There's these new ESG rules from the SEC. Who knows where they're going to go? There's things specific to water with lead and copper, where increased regulations also offers interesting innovation. And so when you think about circular economy, it's a systems approach. So circular economy is all about reducing the use of materials, redesigning materials or inputs to be less resource intensive, and recapturing waste as a potential resource. And so if you think about taking a waste stream and turn it into a marketable asset, in the case of industrial circularity, most corporations aren't necessarily looking for another revenue stream. They want to reuse materials for either sustainability or cutting cost or dealing with labor or lessening their expensive waste streams. So a great example of that might be the battery supply chain, right? You have a battery, we'll go to EV battery, right? It gets to some useful lifetime, use about 80% charge. And then what happens is very large format battery that has both valuable metals in it and also could be hazardous waste, right? There are startups and opportunities. And we have our own businesses where they're dismantling these batteries, testing them and say, hey, are there still good? So a large EV format battery is actually made up of a number of individual batteries. Are there individual batteries in here that could be remanufactured and reused in an electric vehicle? Because that's the highest and best use of that waste. Then they look at that and say, okay, well, maybe these batteries aren't good for a car, but they might be good for energy storage, for a wind farm or some other renewable energy. And so a lot of those batteries that are still good enough and have some useful life can be used in another manner called second life, right? And then at the end of the day, if it's not good for either of those, can you recycle them and get out the lithium, the cobalt, the nickel, all these metals that we hear about that, the alternative is mining. And there are lots of challenges on the mining side. Can you do basically urban mining and get valuable materials from our waste streams that are local and regional? So I'll pause there. Those are things that I'm quite excited about. More on the circular economy side, and happy to go into water as well.
Yes, please. I would love to also hear about water. For me, circular economy is a bit far away. I haven't talked much about it, so it was super interesting. But I'm also very interested in water because, and I'm purposely going to sound dumb here, yeah? It's falling from the skies and there is rising sea levels every time. And this is on purpose, but please give us an expert view on why water is so important in the future.
Yeah, sure. And everyone talks about carbon and they don't understand there's the water cycle. There's the carbon cycle, which is incredibly important to life on the planet, but there's also the water cycle that you mentioned. And it's been largely ignored, I believe, in the sort of investing sector in general. But you're also hearing, there's all these droughts, different places, there's floods, other places. And turns out, I think something like 40% of the water that's waste is also industrial water. And so I spend a lot of time thinking about industrial. The rest of it is municipal water, right? And so maybe I can speak a little bit to the industrial water side because this is where I've made a number of investments on behalf of HG Ventures and think it's really, really interesting. I mentioned about industrial processing sites either having to haul their water offsite to be tested and treated, or they have literally some technicians standing over a bucket testing their water and stirring in chemicals to make anything that's dangerous drop to the bottom, and then they haul away that sludge. And then they test the water to see if they can basically dump it down the drain and send it back to the water infrastructure, right? You've got these aging infrastructure and the infrastructure bill. There's issues all over the place. And there's change. Utilities are set to spend trillions on infrastructure. They're changing how they deploy this capital. So there's opportunities in a bunch of different areas on the investing side. A couple that I'll mention. One would be this on-site treatment, right? An automated small-scale process that can measure contamination levels and treat the water so it can be safely discharged to the public utility. Or you can recycle it back to your facility. There's so much water being used in agriculture and in semiconductors, and just the amount of water that's used in industrial, I think, goes unnoticed in many ways because it's been cheap for most of our lifetimes. There's tech areas in this particular sector that are interesting and investable. You've got sensor technologies, processes from separating the water from the contaminants. You capture the contaminant if it's, say a valuable metal, or you might destroy the contaminant. We've got a couple of investments we've made in that sector. And then the digitization side. Most water systems, everyone talks about keeping track of assets in their facilities or communities on paper or even Excel documents. You're needing to manage your data better. It's a critical component to compliance, consumer education. How do you make informed decision-making about what gets fixed and what doesn't? And so sensors and the software to interpret these results have really improved detection and what is actually in our water so we can fix it, right? Step one is knowing what's in there. And step two is what are you going to do about it? There's also a lot of demand on the automation side. If you think about anywhere capital might be deployed into infrastructure, I've heard you had a couple of infrastructure folks on your podcast. Asset owners want to get as much information as cheaply as possible before they budget and build. Things like risk, carbon footprint, cost of equipment. There's a company we invested in called Transcend that automates this preliminary engineering process. So you can mess around with where the pipes are, where the electrical is before you spend a lot of money on an engineer that could draw up a facility drawing for you. This makes it in a minute. So it's an automated system. And we're seeing more and more folks using machine learning and AI to automate infrastructure type questions. And then on the other side is managing the water, even things like school, water utilities. How do you test, track, and report? Really interesting digital solutions happen there, given the investment needed, especially to replace and monitor these millions of lines that are creating lead or copper problems around at least the US and probably places in Europe as well.
I think this is a good place to try to tie it back to your investment process and the value you're adding. The whole time I'm thinking circular economy water, and you can take this wherever you want, but do you observe those problems by more companies pitching them to you, or do your own research and saying, this is going to be the next big topic and we're actively looking for companies to solve this? Or how did this turn up on your radar? And I guess, or is this something that popped up in the Heritage Group and like the CEO of a portfolio company said, well, actually, like we really have to look into circular economy. How does this develop? And then how you decide, is what we are doing adding value to this?
Sure. And it's a mix, honestly. I'd say when we think about sourcing, we either look inside out. So we go and talk to our Heritage Group companies. Heritage Environmental, like I said, is one of the largest environmental services companies in the US. And so based on that, we know what the waste streams that are coming out. We know which waste streams they are seeing and they can't treat. Incredibly helpful. So then we can go out and actively look for any sort of innovations that can help treat that specific waste stream. And that's happened in some instances. But at the same time, we don't believe that we know everything as a company. And so outside in, we're putting out there in a number of different ways by, this kind of goes to sourcing. Where do companies come from, right? We're talking to other investors often because we have such a narrow scope. Probably 50% of our strong companies that we get in are referrals from other investors because they're not in an investor scope, or they're an earlier stage investor, or they're other CVCs. We happen to be a corporate venture arm that leads. Many CVCs don't actually lead deals. And so we often will see a deal, a CVC says, hey, I really like this deal. I would like to participate in this. Is this something that you would consider leading, for example? And so we look at it both ways. We are actively going out and pursuing very specific themes, right? One has been water in the last year. Others have been battery recycling in previous years. We've had themes like sustainable aviation fuel, where we're actively going and looking for companies that are solving very specific problems, but also our door is wide open, right? We have to do our best by being on podcasts like this. Thank you for having me, going to conferences, talking to folks like Global Corporate Venturing, our other portfolio companies, to say, hey, we don't know everything. What else is out there a problem that we can't fix? But you are right in that we will only invest in areas in which we can help. And I put that in quotes, kind of like maybe VCs might put adding value in quotes, right? Like you said, capital is a commodity. And generally, we work with our portfolios on a couple of different things, or look for companies where we can add value in things like deep market insights, stuff you can't find online. We know what the pricing of chemicals are, or the pricing of various raw materials are right now, how they're being distributed, what's competitive pricing, who do we use to move goods? Like we're helping a portfolio company get a very large piece of equipment from Brazil. And with the supply chains and channels right now, they're like, I don't know. And I can get on the phone with someone from my specialty chemical company and say, hey, we use this company in Brazil, and you can put it on this boat and send it to this port, and that's the best one right now. And that's so valuable. That's information that a startup cannot get really easily. We're also walking our portfolio companies with our sales teams from the environmental into large customers. For example, walking them into a purchasing manager. We made an investment in a company called Zwitterco a couple of months ago, and we just installed a system in our lab so we can test our customers' water with the Zwitterco membranes to help their sales engineers. And so we have a lot of R&D talent that we can use and have access to expensive equipment that a startup can never have access to. So we get little vials of things sometimes and say, hey, can you help me figure out what's in this? I don't know what's going on. And I'd say the last thing we add value on is on pilots. The industries in which we invest often have first pilot and sales cycle risks. We're talking about selling products to industrial corporations and then selling B2B. You have to recognize these corporations aren't moving at the same speed as a startup. And many corporations don't want to be first. They are looking for validation from someone else. And so we have been a pilot tester or a customer for, I don't know, maybe at least a half to a third of our portfolio company. That's a huge focus in our accelerator program, as well as getting some initial pilots so we can be a reference for those customers.
I think, could you expand a bit on pilot risk? Does it mean you're not even get to a pilot, or you run a pilot and then it's not working? What is the risk associated with that? And why is it in a B2B kind of manufacturing heavy so important, right? I did a B2C startup, and we did a pilot that was like, hire a developer, build a website, and then put some marketing on it, right? It's an important step, but why do you put so much emphasis on this piloting phase?
A couple of different reasons. One is often to run a pilot, you're having to turn off a very large piece of equipment and run something unknown. And so there are risks in capital, there are risks in time when you do something like that, right? Piloting, like for example, in a cement company, you've got $1 billion cement manufacturing plant that you may have to take down and run something else in it. And if that piece of equipment goes down, that's a huge challenge for that particular plant. And so there are a lot of steps that people take to say, how do you de-risk it in order to get to that last important step of trying it? Same thing with a car, right? Like EV battery in a car, that's a 4-year cycle of trying to figure out when you first say, oh, this battery could be a great thing, to when it actually rolls off the lot, because you have to do so much risk mitigation along the way. And you have to know what are those gates that Volkswagen needs to see before they're willing to put your battery sensor in their car. And that just takes a lot of time, and it takes the right relationships and patience and capital to get, the 4 years to commercialization, something that we have to be aware of as an investor in this sector. And so it's about opening the first door beyond our company, right? It's about showing other industrial companies that we've at least vetted it in terms of the technology. We've vetted it in terms of sometimes a big piece of equipment, or people that run that piece of equipment, by saying, yeah, this is legitimate.
This is so different from, I listen to a lot of Y Combinator talks. They're like, yeah, build a pilot. And it was like 2 weeks, done, website is over. Get some people on the platform, see if the marketplace works, right? This is, I think, I'm really happy we spoke about the difference in a pilot for, like your typical startup that applies to YC versus the pilots you're doing, right? When you have to shut down $1 billion production plan for cement.
Well, it's different. It's like, how do you make money as a VC in the space too, right? Because of that. And it's a J curve, right? It's the same thing in YC, but the curve of capital is completely different, right? The opportunities to scale, but do you know what I mean when I say J curve, right? You get a bunch of money in before you start to make money. Right. It takes time and focus in the industries I'm in to get like a product right. You have to get the supply chain locked in. You often need permits. You need regulatory approvals checked off. You need to be testing with your customers. But once you've got all that together, boom, you can make and sell. When you do things right, you can file intellectual property patents along the way, which creates a legal monopoly. That competitive moat widens over time. So if you compare that to software, like you said, you can release something partially done. You start with early customer revenue, but you have to constantly be improving your product. It takes money along the way to continue improving. And the further you get along, the more competition pops up. It's just a bit of a different trajectory, a different time sale, a different profile over that journey. Like we have a bio-based chemical that we're working on, and like I can't release that if it's half done, right? You might like really hurt someone if I have like half of a fragrance molecule made. So it's just completely different when you just think about in terms of the curve of the capital, the risk profile and whatnot. But these innovations are for massive markets, right? There's economic and environmental and social opportunity in this space, but it takes some industrial expertise. Why not the multiple trillion dollars in energy, multiple trillion dollars in water and in construction, right? So if you figure it out, you can make a lot of money.
Well, what is the biggest reason why your portfolio companies don't succeed? You mentioned, I think, a couple of the, like the typical YC, VC models where, well, competitors just did the same thing, but better, or with more focus, they've been better at operating, building the product, something like that. And the profile, how does usually the revenue profile or the win profile of VC looks like? Out of 100 companies, 90% fail, 10% do really, really good. Do you have the same type of profile? And then what's lacking? Was the technology not right? Did they run out of money before they got to 100%? What are the top reasons, would you say?
That's a great question. And, we're only 4 years in, so I can tell you based on some historical companies that we've seen fail as well. So our profile does look different. We tend to invest a little bit later, I would say, probably mostly Series A, Series B. And when we do a portfolio model. We try to actually compare ourselves to a traditional VC. We measure IRR and all of that And I would say, use the baseball analogy. Everyone's looking for like the one home run. We are modeling many more doubles and triples. It's much more likely that a company will exit a little bit earlier, have an M&A event here rather than have a big booming IPO. Now, we did have a positive exit with a SPAC unicorn. So there's our one big exit so far. But generally, we're modeling to smaller wins, but more of them, less failures, because sometimes the technology is more de-risked by the time we see it. So when thinking about companies that are failing, I would say probably the number one time is underestimating the time to market and running out of money, not being able to validate that their product really matters. And I mentioned unit economics. That's why we spend so much time to it. Is the product actually going to make money when you consider things like the logistics, the supply chain challenges that have happened recently with pricing of oil and steel and plastics and other commodities? The unit economics are incredibly important. And sometimes that comes back to the team. Can they tell a story? Can they get the customer excited about doing things? Because customers in our industries tend to move very, very slowly. And so are they accounting for the pilot time and the time it takes to get to a big one in the B2B world?
You mentioned that there's been a lot of investments in Europe happening. Usually it's the other way around, right? The US is leading and US investors just with one eye, with half their attention, look at Europe if there's maybe something, might be something interesting, but they're really so far behind on innovation. You said you approach it a bit differently. Could you talk a bit about the market that you see in Europe versus the US?
Sure. Well, we're in sustainability is a big theme for us. And the regulatory market in Europe is quite different. In my opinion, it's always been ahead of the US here. You've got what I mentioned before, extended producer responsibility. So you not only have the economic rationale for making products and selling products more sustainably, you also have regulatory, both pressure, carrots and sticks for the sustainability aspect. And so if I'm investing in something, say in the circular economy, there's regulatory pressure in Europe that doesn't yet exist in the US. And so if you can figure out these things like battery recycling, like supply chains, how do you build a circular supply chain in Europe? That means those companies can succeed in Europe and have a bigger market in Europe right now due to the regulatory side. And then we can help bring those technologies to the US.
Does it happen in your portfolio companies that actually the European startups now bring technology to the US? You can see I'm from usually a totally different field.
Yeah.
Where it's really hard for European startups to be successful in the US.
Yes. We just made an investment. It just got announced, the German company called Circular that's been doing that exact things, traceability and tracking of batteries for the circular economy. And they have really interesting customers in Europe. And we are actively meeting with them every week to figure out what their strategy is for moving to the US. We're looking at the same thing with a UK company that we have that's doing water treatment for removal of micropollutants, helping them enter the US market. And I mentioned the group Transcend. It's a US and European company now, as well as, all of them actually. Thinking about it, we also have an asset management group called Valoran that's doing some interesting work in traffic management. There's a lot more toll roads in Europe. And so figuring out how they enter the US first in toll roads to help manage those roads more effectively and bring technology to roads, but then expand that into municipalities. So I think we're probably 4 for 5 in Europeans coming over to the US to expand their reach.
Wow.
Yeah.
Very interesting.
You
Very
should
cool
get into
to hear
ESG.
We all should, honestly. That's why I was like, if you look at the history of the podcast, we have so many more people that actively putting this on the radar and saying, hey, I want to talk about my this and this investment, but I also want to talk about what we do in ESG, and it's becomes such a huge topic. And I try to give this also more airtime because I think it's super important and super interesting.
It is, but it's also nebulous, right? There was a big article this weekend in The Economist, and if you haven't read it, I suggest you read it. ESG is such a fluffy topic, and they say, hey, you know what? Let's just focus on E and let's just focus on emissions because it's measurable, intangible, and let's start there, which I think is a really interesting and valuable point to make, and goes a little bit back to where we started, do we have an impact target or not? And the answer is yes, but not in the traditional sense, right? And who knows what will happen given the current market? Maybe it was a nice to have when the market was up. And now that we're, in my opinion, and many people's opinions, in the middle of a correction, we'll see how that lasts.
Yeah, this article was all over my LinkedIn the last week. I haven't read it though. I will do after the podcast, and very, very interesting. I will link to that too. What do you think about the current investment or funding environment for startup?
I think we are in the middle of a correction. If you look at the data that's been out there, the venture activity, I track the corporate venture activity pretty carefully. It's dropped noticeably in the second quarter. Number of rounds involving corporate is down 10%, I'd say. Total value raised in the rounds is down about 40% from a year ago. Drop in the number of deals is much smaller. I think for the overall VC industry, it's seen about a 30% decline in the number of rounds in the second quarter, and the overall value of investments is about the same. I think the number I got from PitchBook yesterday morning was somewhere around 28% in Q2. Things like, rising inflation, commodities, the war in Ukraine, geopolitical tensions, fears of a recession, right? And then you have these monetary authorities around the globe are making their own corrections. Those are things that are not going away in the next couple of quarters, I think, and they've just cooled down the investment activity. And so when you look month over month, you had a nice slow rise continue from January, February, March. And then this last quarter, it's been a steady decline, which is becoming more evident, and a pretty pronounced slowdown in June. And so I think you mentioned earlier that firms have money. Yep, there were absolutely a record number of funds that were raised before the downturn, but LPs are adjusting. Many of them are saying, hey, did you return capital in the last 3 years when it was the hottest market ever for exits? If not, maybe I don't make another investment in your next fund. And people have been deploying funds very quickly. Many LPs modeled out 4 years, and many venture groups have deployed those funds in 18 to 24 months, and folks are getting tapped out and slowing down. For our companies that are raising later stage rounds, we're seeing CVC and VC funds holding off on investments entirely on the growth market or keeping significant reserves for their portfolio. Less so for seed funds right now, but I think everyone expects valuation expectations to be lowered. So if we're seeing companies showing comparables in the last 12 months, you get a little bit of a perception that that's naive and people don't know what's going on, right? I was actually in a board meeting yesterday of one of the, I guess you call a top 10 Silicon Valley VC said, the guidance we are giving our companies is don't ask us for money for 2 years. It will be a flat round or a down round, which I found super interesting. So
I have to think about, you went through Clean Tech 101, the bursting the bubble. Do you feel the same thing happening right now?
No, I don't see the same thing happening with Clean Tech 1.0. I think, it's not just me. We had an expert economist from Wells Fargo come visit our company. I got to listen to what he was saying, and he's saying things that we're seeing. So on the B2B side, the business side, there's such a backlog because supply chains have been slow and unresponsive even in some ways. There's a huge backlog anytime you try to order a piece of capital equipment or get a service. We're not seeing any slowdowns on the business side. It seems to be more consumer driven for this round. And so I think what's happening now is not necessarily what happened in the clean tech bust, which may have been attributed to only a couple of companies that got government funding that didn't go well either. So that didn't help things. But it seems to be more consumer driven this time than business driven. But I'm a chemist, not an economist. So I just read and report what I can and what I see.
Yeah. I mean, let's hope this is, like a temporary slowdown, not a complete bust like it was with Clean Tech 1.0. How does it affect the current market environment? How does it affect how you do deals, how you do business currently?
For us, we have the benefit of being a private company, for one. So we don't swing as widely as some of the public companies do. So we have that. And historically, our group has actually invested in downturn times. And so for us, it's very much business as usual, but we're really thinking about our portfolio companies and figuring out, it's not just about us, it's about the companies in our portfolio. How are they going to figure out if this is a recession or not? How do they expand their runway? We're doing the same things that many firms are and saying, hey, let's make sure, can we get to profitability? Do we need to do a bridge round? Do we need to come up with other solutions for companies that are especially in growth mode? We thankfully are privileged to be in a position to be able to have capital to deploy. And it's about seeing what else is happening in the market and keeping an eye on behalf of our portfolio companies, I'd say more than ourselves.
I mean, even those are not public markets. I mean, one of the probably most well-known guests that we had on the podcast was Howard Marks. And he's a famous contrarian. And I also heard from like the conversations, this is a good time for a contrarian VC or seed stage investor because valuations are not as like 400 or 1,000 times revenue multiple, right? They're like actually decent again. If you now have capital to deploy, there are still great companies out there. And maybe some of the founders that just, did it for fun and jokes and, like, oh, I'll just start it. It's so easy right now to raise capital. They've been maybe not yet, but going to be washed out of the market very soon because they don't have the grit, the tenacity it takes to go through all of that. It might actually be a really good time to deploy some capital right now.
Yeah, there's lots of data that says that great companies were formed during previous downturns and great entrepreneurs are starting companies all the time, right? And right now it's contrarian to make investments. So what the hell? Let's do it.
Let's do it. All right. Awesome. Ginger, thank you so much.
Thanks for spending your evening with me and good luck with whatever you're dealing with in your startup.
Thank you.
No, I just want to thank you for putting this out there and everything you're doing for the financial community.
Thank you so much, Ginger. Have a fantastic day.
Thanks.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Hey again, this is Andy. I hope you enjoyed the episode. If you did, please leave us a 5-star review on Apple Podcasts or wherever you get your podcasts from. Share the episode with your friends, with your colleagues, and everybody that is interested. And if you want to reach out, feel free to drop us an email, a message on social media. And I look forward to hearing your thoughts, your comments, your feedback. And thanks again for listening. Have a great day.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.